You followed structure. You respected liquidity. You did everything right. And still, price came back, tagged your stop by a few pips, and then ran 200 points in your direction. That's not bad luck. That's static risk management in a dynamic market. The pros just don't place stops. They adapt them. I'm Tom Alongi, and this is part 2 of institutional stop loss placement, where I'm going to show you a new time-based adjustment rule that's really going to help you out immensely. Now, in part 1, you learn the 2 golden rules. Structure tells you where to place the stop. Liquidity tells you how far beyond. But there's one more dimension that we're going to add to this, and that's going to be time. Market structure isn't static. Every new candle redraws risk. So if you're holding the same stop that you set 3 sessions ago, you're already trading yesterday's marketplace. So this is rule number 3. Okay, institutional traders trail stops not by indicators, but by market evolution. Every bar, every candle, every session, price creates a new reference point. Macro swing lows, failed tests, or new consolidations. Once a new structure forms and holds for one full session, we shift our protective stop to the underneath that structure, regardless, whether or not we are long or short. So it does a couple of things for us. It locks in realized profits as structure actually confirms our move. It removes exposure as volatility starts to decay. And the idea isn't to actually trail too tight. You want to give the trade room to breathe so that you keep your stop kind of away from the fire. I'll show you exactly how it works right now using a dollar-yen idea. Now, how you could do this as far as time is concerned, whatever your marketplace you're trading at, say if it's a 4-hour chart, you could use the square root of price to get the number of bars that you need in order to say, okay, that's one full session. Okay, so that's an old Gann type of rule. So square root of price right now gives me about 12 bars here in dollar yen itself. So let's say, for instance, if we're looking at this marketplace, we got long on a breakout at right at this price here at 150. What is that, 151.20-ish? Sorry, the price is down here, 151.20. As you notice, I put my stop down here. Okay, but as the market evolved, it actually made a new consolidation phase and then a new breakout phase. Once this happened, once I got my full 12 bars in, okay, away from the price, what I'll do is I would move my stop up to this price right there, basically locking in about a 10-point profit. It's nothing, but I would lose nothing. Now, I noticed the market volatility came down within these, say, 8 to 10 bars, and then actually started rallying higher. Once we start getting up into this area here, and we have the new consolidation phase between here and here, we can actually readjust our stop loss again, locking in more profits. So what I'm saying is, as we move away, another 12 bars occurs and the marketplace creates another higher consolidation. We could actually move our stop loss up into this area here where the new breakout occurred. Okay, so what does that do for you, and why does it work? Well, right now we're locked in 100 points profit, 120-point profit. What we're trying to do is we're trying to give the marketplace space to work so that we can get our trade, get the most out of our long position in dollar yen. Now, if the market comes back out and touches us, at least, we made 100 points, and then we could reevaluate whether or not we wanted to get back in on another long position or not. So why does it work? Well, every institutional dealer runs actually like 2 clocks. You got the price clock, okay, which is how structure shifts, and you got the time clock, how long that structure holds. So retail traders really only think in the second one. They think only in price, never in the time, okay? But time filters noise out. If structure holds through a session or two, say London and New York handoff, then it's confirmed. And that's when, we need to roll stops forward, okay? You don't get chopped by intraday volatility. You never let a winning trade turn into a loss as well. So you always got to be paying attention to what exactly is happening. But I like to use the square root of price rule, whereas I'll take the amount of bars that I need to actually show where my actual session should be. So if it's the square root is 12 bars or 14 bars, that's what I will use. It's an old Gann rule. It's not something that you could set in stone, but it really works for me. So anyway, I actually built a calculator for you guys. It's in the link in the description. It actually has this stop loss placement. It also has where you can move your stops for structure. So link in the description. Grab yourself. You can use it anytime that you want. It's a really cool little calculator. So you got 3 new rules. You got structure, liquidity, and all new time. And that's how basically I would say that you can survive some of the market volatility. So the retail world obsesses over entries. Pros obsess over exits. Exits are much more important than entries. So if you master the framework, you'll finally stop bleeding from stop hunts and start actually getting into better positions. And I'll see you in the next video. Please like and subscribe. Cheers.